Today at the National Press Club, Reserve Bank Governor Philip Lowe. His address follows the RBA's decision yesterday to keep the cash rate on hold at 3.6% after 10 interest rate increases since May last year. Philip Lowe with today's National Press Club address.
Good afternoon, ladies and gentlemen, and welcome to the National Press Club and the Westpac Address, coming to you today from Gadigal country. My name is Laura Tingle, I'm the club's president. Australians have been facing a cost of living shock unprecedented in many people's lifetimes, with everyday bills like electricity and gas skyrocketing in the past 12 months. For the first time in several decades, inflation has been back as a threat at the centre of the economic policy debate. The Reserve Bank, as a result, has undertaken one of its most aggressive ever increases in interest rates in the past year, adding to the shock from price rises in some other parts of the economy. Yesterday saw the Reserve Bank decide on a pause in rate increases amid signs that inflationary pressures may be abating. But the rate shock has only added to questions about the role of the bank and the way it conducts monetary policy, the subject of a review handed to Treasurer Jim Chalmers last week, but not yet publicly released. Reserve Bank Governor Phil Lowe joins us today at this inflection point for the economy and the bank. Please join me in welcoming him to address us.
Thank you very much, Laura, and good afternoon, everyone. It's a pleasure to be back addressing the National Press Club. I'd like to begin today by explaining yesterday's monetary policy decision. I then wanted to discuss why it's so important that we return inflation to target and the role that aggregate demand management and the expansion of the supply side of the economy can play in that task of returning inflation to target. As you would all know, at yesterday's meeting, the Reserve Bank Board held the cash rate unchanged at 3.6%. This is after interest rates were increased at our previous 10 meetings, as you can see here. The decision to hold interest rates steady this month was taken to give the Board more time to assess the economic outlook and the impact of the increases in interest rates so far. Since May last year, interest rates have been increased by 3.5 percentage points. That's a very large increase over a very short period of time, and I acknowledge that it's been very difficult for many people. The first increases were necessary to withdraw the pandemic-era support, and then the more recent increases have been required to move monetary policy into restrictive territory to deal with the highest rate of inflation that we've seen in Australia in 30 years. To be clear, the alternative to the recent increase in interest rates would have been more persistent inflation and ultimately even higher interest rates and more unemployment. So while the increases have been unwelcome by many people, they have been necessary to preserve price stability in Australia. The decision to hold rates steady this month does not imply that interest rate increases are over. Indeed, the Board expects that some further tightening of monetary policy may well be needed to return inflation to target within a reasonable time frame. The Board decided, though, it was prudent to hold rates steady this month to allow more time to assess the impact of the increases in interest rates so far and the economic outlook. The Board's very conscious that monetary policy operates with a lag and that the full effect of the increases so far is yet to be felt. It's also conscious that there are significant economic uncertainties at the moment. Given these lags and the uncertainties, the Board judged that with monetary policy now in restrictive territory, it was time to hold interest rates steady and to accumulate more information. This approach is consistent with our practice in earlier interest rate cycles. In those earlier cycles, it was common for the Board to move interest rates a few times and then sit still for a while as it accumulated more information and then move again in the same direction if the situation warranted doing so. So we're really returning to that earlier world. But given that monetary policy affects the economy and inflation with a lag and that interest rates have been increased so quickly, it's really important that the Board looks to the future when it's setting interest rates. At a meeting yesterday, we discussed a number of factors that will bear on that future, and I'd like to take this opportunity to share three of those factors with you today. The first is the outlook for the global economy, especially in light of the recent banking stresses in the United States and Switzerland. As you know, globally inflation remains too high, and services price inflation is proving to be worryingly persistent. Economic growth has slowed around the world to a below-average pace, and the outlook even before the recent banking problems in the US and Switzerland was for below-trend growth to continue. This week and the last week, we've seen some easing in the financial stability concerns around the world, but even so, the recent problems will result in tighter financial conditions around the world as banks reassess risk and take a more cautious approach to their lending. I think it's still unclear what effect this will ultimately have on the global economy, but it's clearly another headwind. Here in Australia, the impact of the recent banking problems overseas has been limited. Our financial markets are working well, and Australia's banks remain well positioned to provide the credit and the other financial services that the economy needs. Our banks have unquestionably strong capital positions and liquidity reserves well above prudential requirements. They also have very diversified deposit bases, and they carry very little interest rate risk, with APRA requiring the largest banks hold capital against interest rate risk as part of their core requirements, something that regulators elsewhere in the world have not done, and I think that should be rethought. This all means that, as APRA Chair John Lonsdale said last week, Australians could be confident that their banking system is among the strongest and most resilient in the world, with prudential safeguards above and beyond the minimum international standards. This assessment's reassuring, but it does not mean that Australia is immune to stresses abroad. While the authorities in the US and Switzerland took decisive steps to maintain confidence in the banking systems, the situation is still fragile, and recent events have put the spotlight on how rapidly shifts in sentiment can cause very large deposit outflows from financial institutions. Given this, the RBA and other members of the Council of Financial Regulators continue to be in very close contact with our counterparts overseas, and I'll be in Washington next week at the G20 and IMF meetings, which will be another opportunity to assess the situation. A second important factor bearing on the outlook is the strength of household consumption. It's increasingly clear that the higher interest rates are having a negative impact on aggregate household spending. This next graph shows quarterly consumption growth from the national accounts and our current estimate for the March quarter. As you can see, consumption growth has slowed very considerably from the fast rate that was evident during the bounce back from COVID, and consumption growth is now quite a lot below average. Looking forward, we expect that consumption growth will remain subdued for some time, but there are uncertainties here and there are factors pulling in both directions. On the positive side of the ledger, unemployment is low, and households in aggregate saved a lot of extra money during the pandemic. The unemployment rate is the lowest that it's been since 1974. That's nearly 50 years ago. And as you can see in that chart, underemployment is also at a multi-decade low. People are finding jobs, there are plenty of job vacancies, and people are finding the hours of work they want. This is good news, and it's one of the positive legacies of the pandemic. Inflation's another legacy of the pandemic, but low unemployment is one of the legacies of the pandemic as well. And the additional savings accumulated during the pandemic are equivalent to around 20% of annual aggregate household income. So that's a lot of extra savings. Partly reflecting these savings, the median owner-occupier with a variable rate loan is more than a year ahead on their mortgage payments. On the other side of the ledger, though, cost of living pressures are squeezing household budgets right across the country. The decline in housing prices has also reduced measured household wealth, and the 35% of households with a mortgage are experiencing or will soon experience a significant increase in their required mortgage payments. The predominance of variable rate mortgages in Australia means that this is a more powerful transmission mechanism of monetary policy in Australia than it is elsewhere around the world. As you can see in this chart, since interest rates started rising, the average mortgage rate that Australians pay has increased by more than the average mortgage rates that other countries pay. This increase in mortgage rates in Australia has had a significant effect on household budgets and household spending. We anticipate that the required mortgage payments will reach a new record high of close to 10% of household disposable income by the end of next year. So it's been a large and a rapid increase, and it's clear it's affecting spending. We're also conscious that the savings buffers are unevenly spread across households. While many households built up large buffers of savings in their mortgage offset accounts during the pandemic, around 30% of owner-occupiers with variable rate loans have an offset or redraw balance of less than 3 months. So they have very small repayment buffers, while other households have very large repayment buffers. And there are still many fixed-rate borrowers to transition to higher variable rates. We expect around 880,000 to transition this year. And it's also unclear whether those who have built up these additional savings will treat them as wealth and spend the funds slowly over time, or do they see these additional savings as a pot of money to be used to support spending this year or next. So there are questions here about the outlook for household spending. It means that we're monitoring the various indicators very closely, and it's a significant source of uncertainty about the outlook for our economy. A third important factor that will shape the outlook is how price and wage setting behaviour responds to this period of high inflation. To date, wage outcomes have been consistent with inflation returning to target, provided, and it's an important proviso, provided that there is some pickup in productivity growth, something I'll return to in a few minutes. As you can see from this chart, wages growth is higher than it was a few years ago, and it's a welcome development. It's also noteworthy that the recent high inflation has not been driven by excessive wages growth. In terms of price setting, the experience differs across firms and across industries. However, at the aggregate level, the share of profits in national income, excluding the resources sector where prices are set in global markets, has not changed very much over recent times. A reasonable interpretation of this evidence is that while firms on average have been able to pass on higher costs and maintain their profit margins, inflation has not been driven by ever-widening profit margins. Looking forward, it's important that wage increases remain broadly consistent with the inflation target, and that a widening of profit margins does not become a source of ongoing upward pressure on prices. The board's watching developments in each of these three areas very carefully: the global economy, trends in household spending, and wage and price setting behaviour in the economy. Our central view, though, remains that economic growth will be below trend for a while, that unemployment will increase later this year, and inflation will decline gradually over time. It's a narrow path here, though, and there are plausible scenarios in both directions. Before we take our next interest rate decision, which will be in early May in Perth, we will conduct a full assessment, a full review of the forecasts and the various scenarios for the economy and inflation. As we take our decisions each month, the board's priority remains to return inflation to the 2 to 3% target range in a reasonable time. It's important that we do this because persistently high inflation is corrosive and it damages our economy. It hurts us all. It erodes the value of people's savings. It puts pressure on household budgets, and it hurts people on low incomes the most. High inflation also makes it harder for businesses to plan and to invest. And if inflation becomes ingrained in expectations, it requires even higher interest rates and a larger increase in unemployment to get it back down again. It's for these reasons that the board remains resolute in its determination to return inflation to target, and we will do what's necessary to achieve that. As you would all know, a primary task of any central bank is to preserve the value of money. And the tool we have to do that is interest rates. In principle, different institutional arrangements could be designed and non-monetary tools could be developed to help contain inflation. In practice, though, things are more difficult, and the use of other tools would raise a new set of complexities and operational and governance challenges. It's also worth recalling that the task of controlling inflation has been assigned to central banks, following years of experience with other arrangements that didn't work out so well. We don't operate in a vacuum, though, and other policies affecting aggregate demand and aggregate supply also affect inflation outcomes, and we need to take those into account. Broadly speaking, inflation is determined by expectations of future inflation and the balance of supply and demand in the economy. If demand is strong relative to supply, prices rise more quickly. When firms are operating close to capacity, they have little incentive to discount and production costs tend to increase. And when there's strong demand for labour relative to supply, workers tend to seek and obtain larger wage increases. So both the demand side and the supply side of the equation matter for inflation, and policies on both sides affect inflation outcomes. At the RBA, we work primarily on the demand side of the equation. Our tool, interest rates, influences the level of aggregate demand in the economy. At any point in time, we have to take the supply side as given, even though in the long run, successful monetary policy can create conditions that promote investment and expansion of supply, but in the short run, we need to take the supply as it is. Our job is to make sure that demand grows in line with supply. Over recent times, we've been working to slow the growth in aggregate demand to establish a better balance between demand and supply in the economy in an effort to shorten the period of high inflation and to avoid an unhelpful adjustment up in longer-term inflation expectations. Notwithstanding our focus on managing aggregate demand and inflation expectations, supply-side considerations feature very heavily in the board's deliberations month to month. And that's because supply-side considerations can and do influence inflation outcomes. We saw this very clearly during the pandemic, and a really good example of this is the price of shipping a container, which you can see here. It surged during the pandemic but is now normalised. The higher shipping costs flowed through into prices, and we're now expecting and hoping that the lower shipping costs will translate into prices that Australians pay for goods at the shops. So the supply side matters. But now that the pandemic is behind us, the board's attention has turned to a few other important supply side issues. And the first of these is the balance of supply and demand in the housing market. As rents make up 6% of the CPI, what happens to rents can have a significant influence on overall inflation and on people's living standards. As you can see in this graph, over recent years, the growth in the number of dwellings in Australia has exceeded growth in our population. This was especially so during the pandemic, when population growth slowed to its lowest pace since the First World War. Despite the slower population growth, there was only a modest increase in the rental vacancy rate. This is primarily because the demand for residential floor space increased as people work from home and the average number of people living in each household fell. As you can see in this chart, there was a very sharp decline in average household size during the pandemic. But we're now in a different phase following the opening up of Australia's international borders. Population growth has picked up very sharply, and it now seems likely that the annual rate of population growth will soon be around 2%. As you can see in that chart, that is close to the peak reached during the resources boom. In contrast to this strong growth in demand for housing, the expansion of the supply side of the housing market is expected to be fairly modest. It takes a long time for housing supply to respond fully to shifts in population growth. In the previous episode of strong population growth during the resources boom, it took nearly 5 years for housing supply to respond. One possible adjustment over the next short period of time is that the average number of people living in each dwelling might increase, reversing the pandemic period fall. If that were to happen, it would reduce the overall demand for new dwellings. But even if it were to happen, it's likely that the balance between demand and supply in the housing market will result in rent inflation being quite high for a while yet. And this will be one of the factors adding to inflation over the period ahead. Another area where supply-side factors are having important bearing on inflation is in the energy sector. The price of electricity as measured in the CPI increased by 12% last year, and we're expecting a further increase of 15% this year. This surge in prices is not because the demand for electricity in Australia has been unusually strong. As you can see here, total electricity consumption in Australia has been little changed over the past decade. People and businesses have found efficiencies and the nature of production in the economy has changed. Yet despite the demand for electricity not changing much for a decade, prices have surged very significantly. The reason for that lies on the supply side. We've seen interruptions to global supply and there have been domestic supply side constraints as well. Some of these factors have since abated, which is good news, but avoiding a mismatch in the timing between the ageing of existing production generation capability and the installation of new renewable energy supply will remain a challenge on the supply side of the electricity market for some time to come, and this will affect the inflation outcomes in Australia. But beyond these specific areas of housing and energy, there's a more general supply issue it's really important to remain attentive to, and that's productivity growth. Faster growth in productivity means we can produce more with our resources. It means a bigger pie for us all. It means higher real wages. It means a lift in our collective wealth. And it means a more prosperous economy. And higher productivity growth also means for a while less upward pressure on prices and inflation. Over recent years, Australia's productivity performance measured by output produced per hour worked has slipped, as you can see in this chart. Indeed, the level of labour productivity in the December quarter last year was the same as it was 3 years earlier. No growth at all. This compares with average growth in labour productivity of 1.25% per year over the previous 3 decades. The fact that the supply side of our economy is growing more slowly than it once did carries the implication that demand also needs to grow more slowly than it once did if we are to avoid persistently high inflation. Given the importance of lifting productivity growth, it was pleasing to see the Productivity Commission's most recent 5-year report. The good news in that report is there are plenty of ideas on how we can lift productivity. The task we all now have, both government and business, is to implement some of those ideas. I'm raising these supply-side issues because they matter for inflation and they help shape the context within which the board makes its decisions. The standard view is that monetary policy can look through short-term supply shocks. That's provided that medium-term inflation expectations don't adjust to variations in inflation caused by these shocks. If inflation expectations remain well anchored, inflation should return relatively quickly once the shock dissipates. And this means that monetary policy most of the time doesn't need to respond. On the other hand, if inflation expectations do increase and wage and price setting behaviour responds to the higher inflation, an interest rate response is required. And the more the prices and wages respond to a period of temporarily high inflation, the greater will be the need for interest rates to respond. The situation is a little more complicated when the supply side issues are persistent, leading to persistently higher price increases in parts of the economy. And here there's a greater risk that inflation expectations and price and wage setting behaviour adjusts. Again, if this were to occur, a more decisive monetary policy response would be required. Our current forecast is that inflation returns to the top of the target range, but only by mid-2025. And this forecast takes into account the supply-side considerations that I just discussed. It's important to point out, though, that while supply-side factors are influencing how fast inflation returns to target, they cannot They cannot be a reason to tolerate higher inflation on an ongoing basis. Dealing with the supply-side issues that the economy faces will be harder, not easier, if inflation stays high for too long. So the board is committed to making sure that this does not happen. We're committed to making sure that inflation returns to the 2 to 3% range, and to do that by mid-2025. And we'll do that with interest rates, and hopefully in a way that preserves many of the job gains that have occurred over recent years. To conclude, we face a challenging environment, but Australia is better placed than most other countries. Our banking system's strong. We have the lowest unemployment rate in decades. The prices of many of our exports are very high, and many households saved a lot of extra money during the pandemic. These are all positives for our economy. At the same time, many households are feeling a painful squeeze on their budgets. Inflation's also too high, although it is now coming down due to both a resolution of some supply-side problems and the effects of the RBA's earlier tightening of monetary policy. This month, the board decided to hold the cash rate steady after increasing interest rates at the previous 10 meetings. This will provide more time to assess how the various influences on the economy are balancing out. At our next meeting, we will again review the setting of monetary policy with the benefit of an updated set of forecasts and an updated set of scenarios. So thank you very much for attending today and for listening, and I look forward to answering your questions. Thank you.
Thank you, Governor. We've got a... can you hear me okay? Yes. We've got our lunch today in Sydney, but I'm going to ask you a bit of a Canberra question. You're going to have your next meeting a week before the budget is brought down, but I wondered if you could give us an idea of what you think, what is the best ideal macro setting for the budget in terms of assisting the Reserve Bank do its job in managing that demand side and inflationary pressures, and at a micro level of the budget, if you like, given those consumption trends that you were showing us, would it necessarily be a bad thing if the government were able to find the money to help lift more people out of poverty by lifting welfare payments? Would that actually be a positive for the economy?
Well, the government doesn't offer me advice on interest rates, as you know, so I'm reluctant to offer public advice on fiscal policy, but the strategy of retaining to the bottom line most of the boost of revenue that's come from both bracket creep now and the higher commodity prices, saving that to the bottom line in an effort to repair the medium-term budget position, I think makes sense. So within that general framework, there may be scope to kind of help certain parts of the population who are really suffering, but the general principle of saving most of the surprising boost in revenue, I think, is the right one at the moment. It's important that we return the budget to medium-term balance. That gives us options in the future. There are huge demands on the public purse, and we're better off returning the medium-term position to balance. I think that should be the priority at the moment.
Next question is from Shane Wright.
Governor, Shane Wright from the Sydney Morning Herald and The Age. Good to see you again. Australia has some of the most expensive housing in the world. Our households are among the most indebted in the world, and the mortgage books of the 4 large banks are equivalent to 70% of GDP. In 2005, they were at 25% of GDP. Is the economy and the banking system being distorted by our love affair with housing? And do you think that the focus that we have so heavily on housing is one of the factors in the slowdown in productivity over the last couple of decades?
Well, there's a slowdown in productivity right around the world. I think it's another one of the legacies of the pandemic. It disrupted the nature of production, and we've seen slower productivity growth here and elsewhere. So I wouldn't blame the slowdown in productivity on our kind of focus on housing. But Australians have chosen to live in by and large, in large capital cities on the coast with fairly large blocks of land and historically underinvested in transport. They're the reasons we have high housing prices. We have high housing prices because the price of land is high that's embedded in each house. And it's high because the choices we've made as a society, where to live, how to tax housing and how to invest in transport. So that's the issue. We've made choices collectively as a society to give us high housing prices. And I wouldn't say that it's a distortion, but it's the consequences of the choices that the people who live in Australia have made. And we have to live with that.
Tom Dusevic from the Australian newspaper. Governor, what makes you confident of pausing your monetary tightening when most of your peer central banks around the world continue to push up interest rates? What's so special about Australia?
There are a few things that are different. One is that wages growth here hasn't picked up to the same rate as it has in some other countries, particularly in North America. Wages growth in aggregate at the moment maybe is 3.5%. In Canada and the US it's maybe 4.5%, 5%, and in some European countries it's picked up as well. So we've got lower wages growth, which allows us to be a bit slower with raising interest rates. I think the other factor is that we have all this variable rate debt. As I showed in one of my graphs, the increase in the average mortgage rate that Australians pay has been faster and larger than elsewhere around the world. One would expect that would have a more subduing effect on household consumption. So there are two factors. I think a third one is that the Reserve Bank Board is prepared to have a slightly slower return of inflation to target than some other central banks. Our last set of forecasts have inflation returning to target by mid-25. That's partly because of the supply side things that I talked about. Some other central banks are getting inflation back down more quickly. We've discussed that at our board meetings, whether it'd be beneficial to get inflation back down to 3% a year earlier. There's an argument for that, but it would mean job losses, more job losses. And our judgment at the moment is that if we can get inflation back to 3% by mid-2025 and preserve many of those job gains that have been delivered in the last few years, that's a better outcome than getting inflation back to 3% 1 year earlier and having more job losses. So it's the policy reaction function, the wages, and the fact that we've got variable rate debt. There are three factors that at least establish a plausible case that interest rates in Australia don't have to go up to the same level as we've seen elsewhere around the world, but there are a lot of uncertainties here and that could change.
Stella Q.
Hi, Governor. Stella Cho from Reuters. So you listed a lot of reasons for pausing in yesterday's statement and today, like a forecast CPI moderation, squeezed household budgets and spending, slowing economy and unemployment picking up. Now that you have paused, what will be the trigger for you to restart hiking again?
So I missed the last part.
Now you have paused.
Yeah.
What will be the trigger for you to restart hiking?
Well, as I said, we'll at our next meeting we'll have a new set of forecasts. We'll have an updated inflation reading. We'll have the regular flow of monthly data on the labour market and business sentiment and household spending. So we'll take all that together, and if we decide that we need higher interest rates to get inflation back to target over the next couple of years, that will be the trigger. At the moment, we think we may well have to increase interest rates again, but we're not 100% certain of that, and the flow of data from month to month will determine whether we need to move higher.
Jonathan Shapiro.
Jonathan Shapiro from the Financial Review. Thank you, Governor. I was following from Stella's question. If you look at market pricing, as of yesterday, it seemed to entertain a slight possibility that the Reserve Bank may move again in May. And beyond that, pricing in a flat curve or potential cuts. So if I could speak for the market, which is a very dumb thing to do, it seems like what it's saying is either the Reserve Bank will move in May or not at all. Do you think that is a fair assessment? And following on that, what sort of time frame do you think is appropriate to assess, the long and variable lag of monetary policy?
Well, I don't really want to comment on the market's assessment. If we were to hold next month, that doesn't mean that we're going to hold kind of right through the course of the year. Each month we look at the data we have before us, look at progress on inflation. Are we going to get it back to target within a reasonable time? So that's the framework we use, and we look at that month to month. So the second part of the question.
Is there a reasonable time frame to assess the...
Well, it depends upon how the data unfolds, doesn't it? If the situation remains unclear next month, then we hold steady. We kind of until we get a clear signal one way or the other. But I do think it's premature to be talking about interest rate cuts. Remember, we've got the highest inflation rate in 30 years, the lowest unemployment rate in 50 years, and still 2 years before we get inflation back to the top of the target range. So I think it's too early, way too early to be talking about interest rate cuts, and the balance of risk lie to further rate rises, but it will depend upon the data.
Peter Ryan.
Governor Lowe, Peter Ryan from the ABC. Thanks for your address today. Just a question about the mortgage cliff. We have hundreds of thousands of borrowers facing this cliff, which is looming in a few tranches over the next year or so as those fixed mortgages move into that higher rates world. Do you see that as an emerging shock down the road? And what role did that play in yesterday's decision to pause rates at least for April? And also the pressures, particularly on low-income families who might have bigger mortgages compared to their incomes. What sort of data does the Reserve Bank collect from charities, for example, Lifeline, that are really dealing with families that are going to the wall and even thinking about how they're going to pay the supermarket bill?
Yeah, the first part of the question about the mortgage cliff, I don't like that, the cliff analogy, because this is not a cliff. It's kind of a ramp up. I mean, a lot of people have already transitioned who had fixed rate loans to variable rate loans, and the banks tell us that people who've already transitioned are performing as well with their mortgages as the people who had variable rate loans. And we've got to remember that many of these people who've had fixed rate loans for 1, 2, 3 years have paid much, much lower interest rates than the rest of the community for that time. And some people I know, because they write to me and they say, well, we've saved the money. So we don't like paying the higher interest rates on the variable rate debt, but we've saved some of the money because we've been paying low fixed rates. Other people have used the low fixed rate to kind of spend for their household and going to face a difficult adjustment. But the fact that they've known for some time they have to pay higher rates. Most people are sensible and I think have been planning for it. It doesn't make it easier, but they've been planning for it. And the banks tell us that they're working very carefully with those customers. They make the transition, and there's been no deterioration in the credit quality of those borrowers. So this hasn't come as a kind of a surprise on day one. This increase in interest rates has been coming for some time. So people have had time to plan. What contact do we have with the financial counsellors and others that through our liaison program we talk to them, and they tell us that at the moment they're getting increased calls for people saying they're in stress. And a lot of those calls, interestingly, are coming from people who rent, at least as many at the moment. So rental stress is at least as big an issue at the moment as mortgage stress. And in the coming month, I'm meeting with a number of the service providers in this area to hear the stories directly myself, and quite a few Australians write to me telling them the very difficult situation that they're in, and I read those letters with a heavy heart. But when I read them, I think, what is the alternative? If we didn't put up interest rates, what's going to happen? Inflation will stay high, interest rates will have to go higher later on, and there'll be more unemployment. So at the individual level, it's very difficult. But this rise in interest rates has been necessary, and if we didn't do it, then there's more pain down the track. So it's a hard message, but it's the truth.
Eddie Meyer.
Governor, good afternoon. Eddie Meyer from 9 News. I just wanted to focus on a comment you made in your speech about some of those tools other than interest rates that could be employed to bring down inflation. Given mortgage holders might be feeling unfairly targeted at the moment, why is it difficult to employ those tools? What are the dangers?
Well, broadly speaking, there are kind of two, this is at a very high level, two sets of tools, things that improve the supply side of the economy. If we could improve supply, then demand can grow more strongly without causing inflation. For a while, we could have less pressure on interest rates. So the difficulty is that the supply side, it takes a long time to change. Talk about how hard it is to change the supply side of the housing market, and we all know how hard it is to change electricity generation capacity. So, but in principle, that's a tool. The other tool is using fiscal policy to manage aggregate demand. So at the moment, at least again conceptually, an alternative to higher interest rates would be more taxes. When people are suffering kind of cost of living pressures, does the community want that? And the history has been, for better or worse, that using fiscal policy in that type of counter-cyclical way has a lot of both political and economic problems. And that's why the task of using a tool to manage aggregate demand has been assigned to central banks. Raising interest rates is very unpopular, as I know, but it's our job and we do it. It's harder for the political class to do that. In principle, you could design different arrangements that would allow them to do it, but that's a big redesign of our system, and then there's the supply side to work on. In the absence of other arrangements there, we have to do what we need to do with interest rates to manage aggregate demand to keep it in line with supply. That's our task.
Ursula Hager.
Dr. Lowe, Ursula Hager from Channel 10 News. Thank you for the speech. I'm interested in your assessment of a report by the Australia Institute Centre for Future Work back in February. I don't know if you've had the chance to read it, but in summary, essentially it said that the main driver for inflation in Australia is excess corporate profits, not wages, accounting for 69% of additional inflation beyond the RBA's target. So I wanted to ask you, firstly, what you made of that, and secondly, are Australian mortgage holders right now wearing the pain and the consequences of excess corporate profits?
No, as I said in my prepared remarks, that rising profits are not the source of the inflation pressures we have. Outside the resources sector, the share of national income that goes to profits is basically unchanged. I think what's been happening is demand strong enough to allow firms to pass on the higher input costs into prices. So the firms have not suffered a decline in their profits as their costs have gone up, with the exception, I think, of the construction sector. But most sectors have been able to pass on the higher input costs into higher prices, and they've kept their profit margins the same. So rising profits as a share of national income is not the source of inflation. It's the supply side issues and the strong demand in parts of the economy because of the pandemic response. So that's our interpretation of the data, and we've looked at this very carefully.
Poppy Johnston.
Thanks, Dr. Lowe. Poppy Johnston from AAP. Given your concerns about the lingering supply-side inflation risk from housing and energy, do you have confidence in the federal government's policies such as the Housing Accord and bolstered safeguard mechanism to manage these concerns?
Well, it's not my job to express confidence in government policies, but I will kind of re-emphasise the importance of making sure that supply side of the housing market is flexible. And that's just not federal government, that's state government and local government. It comes down to zoning and planning and the cost of developing new subdivisions. So that's a really important issue for a country that has very large swings in its population growth. We need to be able to have the supply side of the housing market respond quickly when population growth changes. And if we can't do that, then we'll have big movements in rents and housing prices. Housing prices in at least some of the cities are rising again. I think it's not unrelated to what's going on with the population dynamics. So I'm not going to kind of express views on the government policy, but I just know it's a really important issue for us to solve.
Ross Greenwood.
Governor Lowe. Ross Greenwood from Sky News. Thanks for your time today. I know you're a man of statistics, and I do note that a professional darts player will hit the target 64% of the time, the bullseye. I note that you've been the Governor now for 79 months, and during that time, inflation has only been in the 2 to 3% band for nine months of that 79 months. The average is 2.5% during that time, spot on, but there have been wide variations, higher or lower. My point to you is, what's the use of having a target if you can't hit it?
We will return. I mean, it provides a very strong anchor point. Just imagine we didn't have a target now, and how would we be explaining what we're doing? At the moment, I think kind of the target is providing a strong anchor for expectations in the community. I hope you believe and understand that inflation will return to the 2 to 3% range. If we didn't have that medium-term anchor, I don't know what you would believe about future inflation, but that anchor, hopefully, provides you confidence that inflation will eventually get back down there. It gets hit away because we had a war, a pandemic, the biggest fiscal and monetary response ever. That meant inflation moved away from the target, but the target provides an anchor. And hopefully, we come back to that.
Michael Pascoe.
Michael Pascoe, The New Daily. Partially a segue to Peter Ryan's question. I note in your speech it indicates that household per capita consumption will be negative for at least 2 quarters.
Yep.
Also note that in the space of a month you've nudged up your estimate for how much household income is going to go on servicing mortgages from about 9.5% to nearly 10%. I'm wondering if you've also revised the work of the Reserve Bank back in October, when the RBA estimated the effect of a 3.5% cash rate on borrowers, when it said that for a third of borrowers they would lose 40% or more of their disposable cash. For 15% they would have disposable cash wiped out, which I think is getting to the point Peter was making. Is it actually going to be worse than the bank was suggesting back in October?
I don't think so. We're going to publish the next update of the Financial Stability Review very soon, and that will have updated calculations about the share of the population that's most vulnerable to rising rates. The estimate for the share of mortgage payments in household disposable income that I talked about today of 10%, that's a bit higher than the previous estimate that I spoke about, just because we've taken the forecasting horizon out a bit longer, and we've worked through the implications of all the fixed rate loans shifting over. So it's going to be a record high, and it's going to be really tough for some households. I acknowledge that. Per capita household consumption is declining at the moment. You're right. That was where we started. Consumption growth in aggregate is slow, maybe 0.3, 0.4 a quarter, and population growth is probably faster than that at the moment. So the higher interest rates are biting. We know that, and the cost of living pressures are biting as well. Many people are finding their real incomes going backwards, and that's affecting their spending. And the fact that we now see kind of clear evidence of the higher interest rates and the cost of living pressures biting is one reason why we thought it was appropriate to hold steady this month and just wait a bit, take the pulse of the economy and reassess.
A tiny clarification. Does that mean we are looking at that technical thing, a per capita recession?
I don't like using that language, but we're expecting growth. Our last set of forecast growth, economic growth this year, about 1.5%. Population growth probably close to 2%. But our last set of economic forecasts were prepared on the assumption that population growth would be slower. So the big pickup in population growth just recently has come as a surprise to us. I think it's come as a surprise to most people. Now, you might recall that during the pandemic, people were questioning whether non-residents would ever want to come to Australia again. We closed our borders and we made ourselves unfriendly. People were asking that. Well, it turns out that's wrong. People love coming here. They want to come here, work, and to study and enjoy the fantastic standard of living we're all lucky enough to enjoy. So people are coming here again, and they're coming in large numbers. they're providing workers for firms, and we have to find somewhere for them to live.
So that does suggest, though, doesn't it, Governor, if you've got 1.5% growth and 2% population growth, that we are talking about a per capita recession, as Michael suggests?
Well, they are both forecasts. And we all know the problems with forecasts, but
so a forecast recession.
One of the issues that we're going to have to work through with our next set of forecasts is how does the stronger population growth flow through to consumption, investment, spending, because that's been a big change, and in our last set of forecasts we thought population growth would be much slower than it's now turning out to be. So we have to spend some time working out what are the implications of that.
Swati Pandey.
Governor, Swati Pandey from Bloomberg News. Thank you for your time today. My question is about inflation forecasts. We have seen the OPEC decision over the weekend. We have minimum wage price decision coming up in a couple of months' time. You have mentioned rent, housing prices are going up. There are a lot of factors that are likely to put upward pressure on inflation. And at a time when other central banks are raising interest rates, RBA has decided to pause. Are we going to be in a situation where interest rates are higher for longer in Australia when there are expectations of cuts in other countries later this year?
Well, I've talked about some of the factors. The fact that lower wage growth is still the case in Australia. If that were to change, then that would be important for us. The impact of the variable rate mortgages, I think it's more powerful here than elsewhere around the world. And the fact that we have a strategy at the Reserve Bank is trying to preserve as many of the gains in the labour market as we can. So they're the reasons that we're our interest rate setting is slightly different from elsewhere around the world. You talked about some of the upward pressures on inflation, but remember there are some downward pressures on inflation as well. The price of shipping that I showed you, you can see this in lots of indicators of supply-side problems. They've largely resolved, and we're yet to see the effects of the resolution of those supply-side problems in prices in Australia. So we're expecting over the months ahead to see quite weak growth in prices of consumer durables. Demand has weakened, and the shipping costs have come down, supply costs have come down, waiting times are back to normal. So we're expecting that to flow through, and the government's initiatives in the energy market to at least reduce the rate of increase in electricity prices will also help. So there are some factors on the downside, there are factors on the upside, and we have to assess them each month.
But are you comfortable with interest rates remaining higher for longer in Australia? Do you see that as a risk?
Well, higher for long, if they need to be, they will be. It's not a matter of me being comfortable with it. If we need to keep interest rates high for longer to make sure that inflation comes back to 2 to 3% reasonable range, reasonable time, we'll do that. But that will be determined by the flow of events, won't it?
Thank you.
Annie Kane.
Annie Kane from Momentum Media. Thank you for your address today, Governor. 10 hikes, then a pause to assess the impact of that. And you've mentioned already, the impact on mortgage borrowers, particularly those on variables who are feeling the pain at the moment. I wonder what specifically you're looking at in the mortgage books, for example, arrears. Is there a certain level you're getting to reach? Is there an unacceptable limit in arrears before you consider hiking rates again? What sort of in the mortgage books are you following to determine the impact on mortgage borrowers?
Well, we're looking at the arrears rates, both 30 to 90 days and above 90 days. We're looking at those arrears data very carefully, and we have very good data flow from the bank and APRA on that. There's no specific thresholds that we have, but the arrears rates at the moment, while they're not the lowest they've ever been, they're close to it. So even if they rise quite a bit, there's not going to be particularly high. One other thing that we're looking at very carefully is the flow of money into mortgage offset accounts, because this is the way that people with a mortgage save. The money goes into the offset account, and we've noticed in the recent few months that the flow of money into these offset accounts has slowed a bit. That suggests that people don't have as many free cash resources as they previously did. So that's a really important source of information. We have very disaggregated data on individual mortgages, which allows us to track households who are putting money into these offset accounts. Some households are taking money out of their offset accounts. So that's a more important indicator for us at the moment than mortgage arrears rates, which are still low.
Thank you.
Ricardo Gonçalves.
Governor Ricardo Gonçalves from SBS. In leaving interest rates on hold after 10 fast consecutive rate rises, what exactly is the message that you hope households will take from that, especially borrowers and renters, when they try to manage their finances?
The message is that we've increased interest rates a lot over a quick period of time, and we're taking stock of the effects of that, and we just want to pause before we proceed. If we need to raise rates again to get inflation back to 2 to 3%, then we'll do it. I know that will be painful, but I just ask people to think of the alternative. If we don't get inflation back to 2 to 3% and we have persistently high inflation means persistently higher interest rates and higher unemployment. So it's very difficult message for people, but the reality we face is we need to get on top of inflation in reasonable time, and if we don't, we'll have higher interest rates and more unemployment. And we're prepared to get back to inflation, the target range, kind of over a few years. We're not on a path to get it back down straight away, because we want to preserve the jobs and that we've been able to generate, and we want to limit to the extent we can the pain the household sector is facing. But we need to get it back down, and I want people to understand that we will do what's necessary to do that, as difficult as that might be in the short term.
Anthony.
Good afternoon, Governor. Hansley of Livewire Markets. Thank you for your address. In the address, you talked a lot about optionality, but I'm curious about how much of that optionality comes down to concerns over a debt trap, not just with consumers, but also at the fiscal and monetary levels, and how much of that has come down to global factors like other central bank decisions or indeed the global banking crisis of late.
And when you say a debt trap, I'm not sure that we've talked about the household debt situation. Is that? I mean that it's I wouldn't use that language, but the higher level of household debt is constraining household consumption. It's clear. We've got highly indebted households facing a sharp increase in interest rates. It's not surprising that spending is slowing, but that's what we needed. It's part of the other uncomfortable truth here. We needed growth in aggregate demand to slow. It was growing too quickly relative to the ability of the economy to produce goods and services. And if we allowed that situation to continue, inflation wasn't going to come down. So that the higher interest rates in a high debt environment is the mechanism through which spending slows. Not the only mechanism. There are other transmission mechanisms of monetary policy, including the fact that it has effect on the exchange rate, on housing prices, and on the incentive for everybody to borrow and save. So we've had to do this to get inflation back down.
Julian Bajkowski.
Governor Julian Bajkowski from the Mandarin. In previous speeches, you've noted that Australians are really good at hoarding $100 bills. I think about 18 per person or something around there. Have you noticed any of these coming back into circulation? And, my service station owner says he's seeing a lot more. So is that something that you're keeping track of in the inflation mix? And the other question is on public sector wages. CBSU's put in a claim for about 20% federally. Standard & Poor's are nosing around the wages book. Where does that fit in the whole inflation mix? What's your perspective on that?
On $100 notes, you're right, there are roughly 1,800 notes out there for every man, woman and child in the country. I don't have my share. I don't know many people who do. So it's hard to know where they all are, but the growth in the number of $100 bills in circulation has stopped, which is unusual. It's been growing at like 6 or 7% a year. So partly that's higher interest rates, isn't it? If you can get 4.5% on your transaction deposit, and if you're not getting it, I encourage you to look around for a bank who'll give that to you. The incentive for holding $100 bills at home under your bed is less. So that's been a change. Whether it persists, it's hard to tell. So, and the second question was
public sector wages.
Public sector wages. It's really important that we don't develop a pattern here where wages and prices chase one another. If they do, then inflation will get entrenched and we'll have to have higher interest rates. We want to return inflation to 2.5% on average over time, and that means on average over time wages growth can be 2.5% plus whatever we get on productivity growth. If productivity growth is zero, it carries implications for wages, doesn't it? If productivity growth returns to 1.5%, we can all have bigger pay rises. So that's the context that we think about it in. Around at the moment, aggregate wage growth is 3.5%. That's perfectly okay. But countries that are experiencing 5% aggregate wage growth are saying they have to have higher interest rates. So that's the choice, I think, as a society we face. If we're going to have much higher aggregate wage growth, we'll have higher inflation and we'll have higher interest rates. That doesn't necessarily carry any implications for any particular wage bargain. I'm just really talking about the aggregate situation we have. We have to have, over time, wages grow 2.5% plus whatever we can do with productivity growth.
Tim Shaw.
Thank you, Laura. Governor Tim Shaw, Director of the National Press Club. Welcome back to the club. It's great to see you and thank you for your speech. Since we last saw you, there's been a change of federal government in Canberra. You may have noted that. And secondly, most recently, in the largest economy in Australia, in New South Wales, Premier Minns has made it an absolute policy assuredness that there will not be any more public asset sales. And he's even looking at trying to bring back into government ownership assets such as transport, etc. Can I just get, without a political opinion, a broad opinion about, from an economic point of view and certainly from the Reserve Bank's point of view, about the retention of assets in public ownership? And in relation to that $1 coin that Prime Minister Albanese, or candidate Albanese, held up, had a resonant effect, and the productivity that you've referred to today, are we going to see small and medium enterprises sharing that profit, following on from Ursula's question, because successful businesses that are profitable and sharing that with their employees? Is that something that will lift productivity?
On the first question of whether assets should be in public ownership, it's very hard to give a generic answer to that, but there are a couple of considerations. The first is, are they going to be better managed under public or private ownership? And we've had experiences in this country where assets managed under public ownership have not been managed well, and assets managed under private ownership haven't been managed well. So it's a matter of getting the ownership right. And it's the second consideration is funding future infrastructure. The strategy of the previous New South Wales government was to build assets, sell them off and use the funds to build more assets, which you can understand that. If we're not going to use that model, how do we fund the construction of new assets? So they're the considerations. What's the most efficient way of managing them, and then funding new infrastructure investment? As I understood, the second part of the question was businesses and workers working together to increase productivity. Well, surely that must be a solution. What's critically important in the end, I think, for productivity is the accumulation of skills and human capital. We'll make ourselves more productive, more wealthy and more prosperous as a society if we can do things smartly. Things that come out of here are going to be the important thing, and how businesses and their workers can get together to get the best ideas to come out of here and to operate with those ideas. I think that can only happen if people work together, can't it? If we're at loggerheads with one another, your best ideas aren't going to come out. You're not going to be as efficient. So,
I hope to see you again soon.
Thank you.
Eric Johnston.
Thank you, and thank you, Governor, for your time and also your patience in answering our questions today. Banking crisis, so something a little bit different from the economy. Just wondering if there's any top-level lessons for Australian banks around the recent strains that we saw in North America and Europe in the banking crisis. And if I could also, second part to that, is there any thought inside the Reserve Bank whether we need to change the maturity of the term funding facility available currently with the banks?
I'll take the second one first. No, we're not considering changing the term funding facility. In fact, I think the first repayments under that facility are due tomorrow.
End of June. Tomorrow.
Today or tomorrow. So this week, and they will take place and the thing will kind of gradually wind down over time as it should, and we're not considering any changes in that at all. In terms of the regulatory responses to the recent banking problems in the past couple of weeks, I've spent too many nights on kind of phone calls with my international peers, and there are a few kind of issues that are coming up that kind of I think need looking at again, not necessarily in Australia but kind of globally. The first is, how do we deal with the situation that bank runs can occur electronically and instantaneously? Previous bank runs, people had to line up at the ATM or at the branch to take the money out, and people got sick of it and some went home. But now you can sit at home and within 5 seconds you can take your money out. So bank runs can occur much more quickly and in larger volumes. So what do we do? Should we think about bank liquidity, and what are the regulatory responses to that? Another issue that's coming up is the need for banks to hold capital against the interest rate risk they hold. And APRA really has been a world leader here, and in most of the international meetings I've participated in, APRA in particular has been called out for being a leader here. I think it's worth taking a look at the design of the deposit insurance schemes again. You know, in the US, they discovered, which is something that I already knew, that failure of a mid-sized bank would be quickly systemic, and then they had to kind of backtrack on their planned response. There's also an issue around the design of hybrid capital instruments and making sure that equity at the bottom of the creditor claim. Another issue that's being discussed a lot is the operation of single-name credit default swap markets. Those markets are very illiquid, and just one or two trades can move the price, and the financial media, particularly in Europe, kind of quickly focus on movements in single-name CDS spreads and kind of can spread bad news. So that's another issue that's coming up. And most importantly, and this is one that we do well in Australia, is making sure that the supervisor does first-rate supervision. It's not just about black-letter regulation, it's about supervision, and APRA again is a world leader on that front. So there are a lot of issues floating around in the international sphere, and no doubt we'll be talking about those in Washington next week.
It sounds like you're just warming up, Governor, but we've run out of time, so thank you so much for your talk today.
Thank you. Thank you. Very good. Thank you. I'll make sure this is on my gift register. Yes, that's good. Thank you. Thank you.